Welcome to Smart Plan Overview, narrated by Sean Doucette and presented by the Massachusetts Office of the State Treasurer and Receiver General. Hi, my name is Sean Doucette and I'm a retirement plan advisor at Empower. Your Commonwealth of Massachusetts Deferred Compensation Smart Plan is a powerful tool to help you on your journey to retirement. This plan is a voluntary supplement to your pension with the Commonwealth of Massachusetts and any other retirement benefits you may have. It provides you with the opportunity to save and invest extra money for retirement tax deferred. Today we are going to talk about the SMART plan and we'll discuss the highlights of the plan, the nuts and bolts of what a 457 deferred compensation plan is and how it works. Then we'll talk about the importance of saving for retirement and how much you might want to save and strategies for investing those savings. We'll also discuss the different paths of investing that are available to you through your SMART plan. Later, I'll also discuss how to get enrolled should you decide to do so today. Remember, it's never too early or too late to start planning for your retirement. Please note that the information I'll provide today is for general education purposes. I'm not able to give legal or tax advice. For that kind of special help, please see your financial planner, attorney, or accountant. Let's talk about what a 457 deferred compensation plan is. A governmental 457 plan is a contributory retirement plan designed specifically for employees of state or local government and public entities like your organization. Governmental 457B plans are created under Section 457B of the Internal Revenue Code. You participate in your SMART plan through voluntary salary deferral, and your contributions and any earnings are tax deferred until withdrawn, which is usually during retirement. The 2024 standard contribution limit is $23,000. Some employees may be eligible for additional catch-up contributions. Your plan also offers the Roth 457 contribution option. The Roth option gives you the flexibility to designate all or a portion of your 457 elective contributions as after-tax Roth contributions, which we'll discuss in more detail later. Keep in mind, your participation in the SMART plan does not reduce your pension or Social Security benefits. When choosing to participate in the SMART plan, know that the state treasurer is committed to providing a valuable savings tool to help you meet your personal retirement goals. The SMART plan has approximately $11.2 billion in assets and over 117,720 participants. The average account balance is $98,743, and there are 28 investment options providing a variety of asset allocation and management styles. There are approximately 700 non-state entities participating in the SMART plan. As an employee of the Commonwealth of Massachusetts, you are eligible to enroll in the SMART plan if you meet the following requirements. You must be a full-time employee and work at least 20 hours a week. The minimum contribution to get started is 1% of your gross income or $10 per pay period, whichever is less. Enrolling is simple, and I will discuss ways to enroll later in this presentation. The annual contribution maximum for your calendar year is shown on this slide. You may also have the opportunity to catch up on your contributions in order to save more for your retirement goals. If you're age 50 or older in this tax year, you can save an extra amount above the regular contribution limit for a total as shown here. In 2024, the over 50 catch-up allows you to contribute an additional $7,500 for a total of $30,500. Section 457 of the Internal Revenue Code also allows participants who are within 3 years of normal retirement age to catch up on contributions not made in earlier years. The additional 3-year contribution limit is shown here, which gives you the opportunity to save up to a total as shown in the table. This catch-up limit will also go up as regular contribution limits increase. It will always be double the regular limit. Please keep in mind that the 3-year 457 catch-up cannot be used in the same calendar year as the age 50 plus catch-up. The purpose of your Smart Plan account is for retirement, so your options for withdrawal can be somewhat limited due to Internal Revenue Service or IRS regulations. You may access your Smart Plan account under the following circumstances: separation from service, attainment of age 59 and a half, your death, upon which your designated beneficiaries have access to your benefits, an unforeseeable emergency in accordance with IRS regulations, a $5,000 in-service distribution, which are available in limited circumstances under the terms of the Smart Plan. After you reach age 59 and a half, and if you have not separated from service, you may elect at any time to begin receiving your retirement benefit payments. Service and support are easily accessible through the Smart Plan website at www.mass-smart.com and the Smart Plan Service Center at 877-457-1900. You may also call your local Smart Plan representative at 877-457-1900, say representative, to speak with a representative Monday through Friday from 8 a.m. to 10 p.m. and Saturday 9 a.m. to 5:30 p.m. If you prefer to talk with your representative in person, you can easily schedule an appointment at www.mass-smart.com. Once you enroll in the Smart Plan, it's important to manage and monitor your account and your complete financial situation to be sure you're on the right path to your destination. You can view your account, get investment option information, or make account changes online or by phone 24 hours a day, 7 days a week, through the website at www.mass-smart.com or by calling the Smart Plan Service Center to access the voice response system. And if you have questions, you can call or email a customer service representative. You'll also receive detailed statements in the mail after the end of each quarter. Be sure to review these statements to verify the accuracy of your account information and any trades you may have made during the quarter. Please notify us as soon as possible if you think that there might be an error in your statement. There are record-keeping and communication fees in the amount of 0.07% on total assets in a participant's account. This fee is capped at $350 annually. In addition, if a participant has an account balance over $1,000, they will be charged a $10 annual fee. All participants with an account balance will have an annual administrative fee of 0.0075%, based on your account balance per year. 1/12 of this fee is assessed on a monthly basis. For example, a participant with a $10,000 account balance would be charged a fee of 0.0775% annually, which is equal to $7.75, plus the $10 annual fee for a total of $17.75 on an annual basis. Each investment option offered through the Smart Plan also has operating expenses that are deducted from each fund's assets before the share or unit price is calculated. These expenses pay for the management of the fund, like securities trading and other day-to-day type expenses. Each fund's expenses differ and are listed in your Smart Plan's fund performance document or in the fund's prospectus or disclosure documents. Here are some questions for you. What do you want for your future? When would you like to retire? And how much income would you like to have in retirement? Maybe you already know, or maybe you haven't really thought about it. Whatever your retirement goals are, it's important to consider the Smart Plan and take advantage of every tool possible to help build your financial future. We will review options for saving for your retirement through the Smart Plan, both pre-tax and after-tax Roth 457 solutions. Tax deferral is beneficial in three ways. One, it lowers your current taxable income because you postpone paying taxes on contributions made to the plan. Two, it allows more of your money to work for you. This includes money that you ordinarily would have paid in federal income taxes. Tax-deferred compounding occurs when any earnings on your account are reinvested and given the chance to earn more money. Three, your contributions and any earnings that accumulate over the years are not taxed until you receive them. That's usually during retirement when you may be in a lower tax bracket. To illustrate how contributing to your retirement account on a before tax basis affects your paycheck, let's assume you earn $30,000 in taxable income annually, and you want to defer $100 from each paycheck to the SMART plan if you are paid every other week or 26 times a year. In this scenario, your biweekly income would be $1,154. If you are not contributing to the SMART plan, your net income is still $1,154. And if we assume a 15% federal and state income tax, you'd pay $173 in taxes. This would leave you a net take-home pay of $981. If you were making contributions into the SMART plan of $100 in each paycheck, your net income is now $896. That includes $100 being paid to your SMART plan, a net taxable income of $1,054, and now your federal and state income taxes are only $158. By saving through your SMART plan, your current federal income tax would be reduced, so it would cost you only $85 out of pocket to invest $100. Now compare how those $100 biweekly contributions could accumulate over time, assuming a 6% annual rate of return, a 15% income tax bracket, reinvestment of earnings, and no withdrawals. By contributing before tax and allowing any earnings to compound on a tax-deferred basis over a long period of time, you could hypothetically accrue more through the SMART plan versus an after-tax savings account in which taxes are paid every year. Your plan offers the Roth 457 contribution option. The Roth option gives you the flexibility to designate all or a portion of your 457 elective contributions as after-tax Roth contributions. For example, if you elect to contribute 8%, you can contribute all 8% to your account before tax or all 8% to the Roth. Or you can contribute 4% before tax and 4% to your Roth account. In other words, you could contribute any combination that totals 8%. Let's summarize some information about Roth 457 by looking at it at a glance. Comparison of a before tax contribution and an after-tax Roth contribution. First question, is your contribution taxable in the year you make it? The answer for a before tax traditional 457 contribution is no. The answer for an after tax Roth 457 contribution is yes. Remember, Roth contributions are made with after tax dollars, whereas contributions to a traditional 457 plan are made with before tax dollars. Next, is your contribution taxed when distributed? For before tax traditional 457 contributions, yes. For after tax Roth 457 contributions, no. What about the earnings on your contributions? Are they taxed when distributed? The answer is yes for before tax contributions. For after tax Roth 457 contributions, the answer is no, provided the distribution occurs after age 59 and a half, death or disability, and at least 5 years after your first Roth contribution. If you meet these requirements, your distribution is tax-free. If you change jobs, can you roll over your account? For before tax traditional 457 contributions, the answer is yes, if you are rolling over your account to a qualified 401a, 401k, or 403b plan, an IRA, or a governmental 457b plan that accepts rollover contributions. For after-tax Roth 457 contributions, you can roll over your account to a Roth IRA or 401k, 403b, or governmental 457b plan that has a designated Roth account and accepts rollovers. Keep in mind that if you change jobs, you can choose to keep your account in the SMART plan and take advantage of all the available benefits. Are there limits for your contributions? Yes. The contribution limits that have been set by the IRS are shown on this chart. If you experience an unforeseeable emergency, can you make a withdrawal? Yes. You are able to take unforeseeable emergency withdrawals from both types of accounts if your plan allows them. Finally, do you have to begin taking minimum distributions at the later of age 73 or the year in which you retire from the employer sponsoring the retirement plan? The answer is currently yes to both. A Roth online calculator is also available to help you determine whether to save in your traditional or Roth 457 account. To access the calculator, log into your plan's website at www.mass-smart.com. Click on the Roth link under the Education tile. This will bring you to the Roth calculator. Here are some factors that may affect how much you save and how you decide to allocate your investments. We're living longer and healthier lives than previous generations. Many will live 20 years or more in retirement and do more while retired. And Social Security probably won't be enough to replace your income. And you can't afford to forget about the effects of inflation. Many financial professionals say you'll need about 70% of your pre-retirement earnings to comfortably maintain your pre-retirement standard of living. In theory, when you retire, you won't have some of the current work expenses, depending on your job, like commuting cost or regular lunches. However, be careful not to underestimate your savings needs in retirement. It's better to have more than expected at retirement rather than less. Today's retirees have an increased responsibility to create their own retirement income through personal savings and investments. Likely sources of your retirement income may include your Massachusetts pension plan, Social Security, and your personal savings. Pension benefits and Social Securities may help cover some of your expenses in retirement, but as you can see in this chart, today's retirees have greater responsibility for creating their own retirement income through personal savings and investments. Participating in the SMART plan allows you to defer a portion of your salary now so you will have access to it in the future. The SMART Plan website has retirement planning calculators to help you estimate how much you may need to save. Choosing a suitable investment mix is an important step in pursuing your retirement goals. Your SMART Plan offers a wide array of investments across and within different asset classes so that you can pick the ones that fit your investment style. Each asset class offers a different level of risk and return potential, and for most investors, it can be wise to invest in all three asset classes. Cash alternative investments include certificates of deposit, or CDs, money market funds, and other short-term securities. Their value is typically steady, so your principal is relatively safe from market ups and downs. Their long-term returns tend to be the lowest of the asset classes, but they can also have a valuable place in your portfolio. Please keep in mind that CDs and other similar bank products are insured by the Federal Deposit Insurance Corporation up to certain limits, whereas other types of cash alternative investments, such as money market funds, are not. Cash alternative investments are not federally guaranteed and may lose value. This chart is for illustrative purposes only and does not predict or guarantee the returns of any given asset class. Past performance is not a guarantee of future results. Governments and corporations issue bonds when they borrow money from investors. Individual bonds have a specific maturity date and interest payments. Bond funds combine many different bonds, and earned income is reinvested into the fund. Bond investments fall between cash and stock investments in risk versus return potential and can help diversify and tone down an aggressive portfolio or help conservative portfolios stay ahead of inflation. When you own a stock, you own a piece of a company. Stocks are considered the riskiest asset class, but they have also historically had the highest returns over time. Of course, past performance is not a guarantee of future results. Stock funds are made up of the stocks of many different companies. Stocks and stock funds are often a significant component of long-term investors' portfolios. When it comes to saving and investing, there's no way to avoid risk. As a quick reminder, risk is the possibility for gain or loss in your investments, while return is the actual gain or loss on your investments, usually expressed as a rate of return. As in life, there are many types of risks when investing. There's the risk of losing money if the markets go down, which it will from time to time, and the risk of playing it too safe and not beating inflation. There's also the risk of not saving enough or not saving at all, and then not having enough to do the things you want to do when you retire. But there are ways to manage your risk. You can diversify your investments by putting your money into different types of investment options. Because you're saving for retirement, you can invest for the long term and try not to worry about each day's market fluctuations. A popular investment strategy is to combine a variety of investments and assets categories like large cap stocks, small cap stocks, international funds, fixed income, bonds, etc., which are unlikely to move in the same direction when the market goes up or down. The goal of diversification is to manage the risk in your portfolio. You should also be aware of being too cautious with your investment choices and therefore not keeping pace with inflation. And you should review your investment choices periodically so that when and if your goals change, you can also change your investment strategy. Your SMART plan offers a wide range of investment options to help you meet your personal investment goals. Remember, your goals and investment strategy may change over time, so you should review your SMART plan account as your needs or risk tolerance change. You may want to review your investment options at least annually or more frequently depending on your individual circumstances. When it comes to investing, people have different comfort levels and experience. To make the investment process as simple as possible, the SMART plan offers two paths to investing for retirement. You can choose whichever path to investing you'd like. 1. Choose one of the SMART Path retirement funds. Or 2. Choose either Empower Advisory Services, offered by Empower Advisory Group, LLC, a registered investment advisor, or select your own mix of individual investment options. Let's start by looking at the Smart Path retirement funds. They are target date funds that provide for a cost-efficient, diversified portfolio in one simple step. The investment mix is managed by an experienced team of investment professionals at AllianceBernstein. These funds are designed for people who don't have the time, desire, or experience to build and monitor their own investment portfolios. What are target date funds? A target date fund typically has a date in its name. This is called the fund's target date. The target date is the approximate year when an investor expects to retire and begin taking withdrawals. A target date fund adjusts its investments over time. As the fund gets closer to its targeted date, the investments of the fund gradually evolve, becoming more conservative to help manage market fluctuations. And it all happens automatically. The principal value of the fund is never guaranteed. The emphasis of funds with target dates further in the future is on growth to build savings. As the fund's target date moves closer to its target date, the investments of the fund gradually evolve, becoming more conservative to help manage market fluctuations. And it all happens automatically. This chart shows how each fund's asset allocations gradually shift from stock funds to bond funds over time. In this glide path, the light purple bars represent more conservative investments, while the blue represents equity or stock investments. As the target date approaches, the light purple bars get wider and the blue bars narrow. This means that the retirement date of the fund draws nearer, and continuing for 15 years past that date, professional fund managers gradually adjust the fund to include bond and short-term investments. So, by the time an investor is assumed to move into retirement, the fund will be invested in a mixture of stock funds, bond funds, and short-term investment focused on preserving money and producing income. This change will happen automatically. The SMART plan offers 13 SmartPath funds to choose from. These are designed for those investing for retirement and those in or near retirement. How do you know which SmartPath retirement fund may be right for you? Add the year you were born and the age at which you plan to retire to get your estimated retirement date. Then choose the SmartPath retirement fund that most closely corresponds with that number and your risk tolerance. Please note, deferring less than 100% of your contribution amount to your chosen SmartPath retirement fund may result in a diversification inconsistent with your target investment strategy. The idea of investing money in multiple target date funds or target date funds and a mix of core funds is certainly possible, but does defeat the purpose of using a target date fund and having your money properly allocated over the course of your life to and through retirement. The SmartPath microsite. Visit the SmartPlan website to learn more about target date funds. Go to www.mass-smart.com and you will see the link in the lower left corner. You can choose to get help through Empower Advisory Services offered by Empower Advisory Group, LLC, a registered investment advisor. My Total Retirement offers a personalized retirement strategy based on your financial picture that is professionally implemented and managed. Customized spending assistance to help retirement income last longer. Online advice recommends specific investment options available within the SMART plan based on your investment objectives. Online advice provides you the flexibility to implement the investment recommendations and manage them online. You probably noticed that My Total Retirement sounds similar to SmartPath retirement funds. Let's take a closer look at the differences. With My Total Retirement, you get an individualized investment selection service tailored to your unique situation, including your risk tolerance and investment time horizon. The SmartPath retirement funds are pre-designed solutions intended for everyone, though with varying ages and expected retirement dates. You can provide Empower Advisory Group with a range of information on your risk tolerance, financial situation, additional savings and investments, and the financial situation of your spouse to help them select your specific investment lineup. With a SmartPath retirement fund, you can select a fund based on your current age, expected retirement date, and risk tolerance. With My Total Retirement, you're charged a fee based on a percentage of your assets under management, in addition to any fees associated with your investments. With a SmartPath retirement fund, you pay no additional fees for the investment selection and rebalancing that occurs. And finally, both My Total Retirement and the SmartPath retirement funds undergo regular rebalancing to ensure that the investments match the target asset allocation and that the fund or your portfolio are diversified. With My Total Retirement, the investments are selected on your behalf by Empower Advisory Group, also known as EAG, from the investment options available in the plan. EAG will select the investments based on your goals and situation. Your outside account information, IRAs, pensions, savings, stocks, etc., if provided, will help designate which investments in your retirement plan are suitable. So I encourage you to provide this information. The benefit is that it creates a better overall representation of your financial situation, which can have a direct impact on the investment advice you receive. After enrollment, you'll receive a welcome kit, which will inform you of what information was used in your enrollment and how your retirement account measures against your retirement goals. It will also offer recommendations that may help you achieve your retirement goals. If necessary, review it for accuracy and provide any necessary updates, including life changes. Example, you get married, have a child, get a significant increase in income. Using this personal financial profile form, which is included in the welcome kit. Then EAG will review the account periodically, including an annual review, and make any necessary adjustments to make sure that the account stays in line with your objectives and reviews your progress towards your goals. Sometimes people never change their initial investment selection in a retirement account, despite changes in their lives and in the market. With EAG, you know that your account will change as needed to stay focused on your goals and to reflect the changes in your life. This doesn't mean your investments aren't subject to the same risks as other investments. As with any investment, the account will still undergo a certain degree of risk and may still lose money due to volatility in the market. Use the personal financial profile form provided in the welcome kit and the annual review to update your account information. How and where you're invested your other assets doesn't change. EAG doesn't make recommendations on how you should manage these assets. It simply factors your other assets into its analysis. How much do these services cost? Online advice is available at no additional cost to you. The fee for My Total Retirement is based on a percentage of your average daily assets under management as shown on the slide. It is debited directly from your retirement plan account balance following the end of each quarter. If you prefer to build your own portfolio, you can do so by selecting investment options from the lineup offered by the Smart Plan. As we discussed earlier, different investment options carry different levels of risk and potential return. It's important to understand your risk tolerance, as well as your investment time horizon before building your investment portfolio. You can find more information about all these investment options on the website at www.mass-smart.com. Some investors may decide they want more investment options than are offered by the Smart Plan. Those investors may want to consider self-directed brokerage accounts or SDBA options. This option allows you to select from a wide array of open-ended mutual funds that are not available through the Smart Plan for an additional fees. This option is intended for knowledgeable investors who acknowledge and understand the risks associated with many of the investment options contained in the SDBA. There is a $1,000 minimum account value required in the Smart Plan and $500 minimum transfer amount. There's an additional annual fee of $50 deducted at $12.50 per quarter. Carefully consider the investment options, objectives, risks, fees, and expenses. Contact Empower for a prospectus summary, prospectus for SEC registered products, or disclosure documents for unregistered products, if available, containing this information. Read each carefully before investing. For prospectus related to investments in your self-directed brokerage account, contact your SDBA provider. The Smart Plan accepts rollovers from other eligible accounts and plans, including 457B, 403B, 401A, and individual retirement accounts, also known as IRAs. Combining your retirement accounts can offer the potential to ease your retirement planning because all of your accounts are in one place. Please note that surrender fees to consolidate accounts may apply. We are committed to helping you with the rollover process. 1. Contact the previous provider to obtain necessary withdrawal rollover paperwork. 2. Call a Smart Plan representative. We will help you complete the incoming rollover form. You are encouraged to discuss rolling money from one account to another with your financial advisor, considering any potential fees and/or limitations of investment options that might result. To enroll in the Smart Plan, visit www.mass-smart.com. Click Register. Then click I have a plan enrollment code. Use the group ID number 98966-01 and the plan enrollment code. Please note that the plan enrollment code does expire June 1st and new codes will be issued after that date. The current code is case sensitive and is uppercase W, lowercase a, uppercase W, the number 8, uppercase N, lowercase m, uppercase T, and lowercase b. Follow the prompts. The website will guide you through the enrollment process. If you already have an Empower account, you will be routed to a landing page that says, "We found you." Click Login, select the Register button, select I do not have a PIN, and follow the prompts to complete registration and enrollment. For future visits to the website, enter your username and password and select Sign In. So what's next? If you're not already enrolled, I can help you with that. If you have already taken the first step, schedule a meeting with your local Smart Plan Retirement Plan advisor by calling the Smart Plan Service Center at 877-457-1900 and saying, "Representative." We can help you take a closer look at your savings and investments, as well as review your retirement strategy. We've covered a lot of material in a short time, so if you have any questions, more information is available on the Smart Plans website at www.mass-smart.com. Or feel free to contact a Smart Plan representative at 877-457-1900 to ask questions or arrange to meet one-on-one with a local retirement plan advisor. Your Empower representative is a retirement plan advisor acting on behalf of Empower Advisory Group LLC, or EAG, and Empower Financial Services. Thank you for taking the time to learn more about the two paths to smart retirement available to you with a Smart Plan.